Our next guest, both with buy ratings on the stock and some new notes. Joining us to discuss Meta, broader tech rally, Truist analyst Yusuf Squali, and Evercore ISI analyst Mark Mahaney. Mark, with a brand new note out today, are you doubling down?
Yes, we are doubling down, I guess. Look, this is not just a year of efficiency. I think it's a year of product cycles at Meta, and I think that's what's underappreciated about the stock. They've done absolutely the right thing in taking out some of these costs. But you've got three product cycles to keep track of. First is the improved ad targeting. Second is the closing of the monetization gap on Reels. But third is what we published a report on this morning. It's this click-to-message opportunity. It's almost 10% of the company's revenue, and I think most investors don't know about this, in large part because a lot of this comes from outside the U.S. through those two messaging apps that they own, one of which is WhatsApp. So we think it's something that can kind of bring this company back to solid double-digit revenue growth. And the last quick pitch on Meta, it's still the cheapest internet stock on a PE basis, and is the cheapest of the large cap tech stocks on a free cash flow basis, EBITDA basis, PE basis, whatever you want to look at. Look, this is a recovering revenue growth story with finally cost discipline. You want to be long Meta.
And your target is 305. Yusuf, do you see it as the cheapest too?
It is one of the cheapest in our universe as well, and I would totally agree with Mark. I would just add a couple of things. One, so the latest drift that they've had should probably add $2 to $3 billion of incremental cost savings that will start literally in the second half of this year and certainly into next year. And in terms of utilization and engagement, what's really impressive, even at their rate, we continue to see them adding users. We continue to see them adding engagement, and that has something to do with Reels. In fact, if you look at the last 4 quarters, they've been gaining share from TikTok in terms of engagement every single quarter, and that speaks to the potential for revenue growth over time.
Hey, Mark, what is the latest with the metaverse? I mean, we've seen him rein in headcount. We've seen him rein in CapEx. Does that mean that his commitment to that longer-term bet is lessened?
I hope so. Investors hope so. But I want to make sure we get the right nuance here. I think Meta as a stock is worth more having these kind of 5 to 10 year bets. I think there probably is a there to the metaverse. And I think there's a right amount of investment into the metaverse for Meta. It's probably somewhere in that single-digit billions range. It's not $15 billion a year. And so I think that's what the market wants to see, that they're willing to kind of trim sales a little bit and cut back the investment spend. I'm not sure we're going to hear that. I think it's a distinct possibility. And if we hear that, that's another leg up in the stock. So I think it's a good long-term bet. We're seeing a few signs that they may be willing to trim sales. I'd love to see more evidence of that, and that would make us more bullish.
Yeah, I guess, Yusuf, where's the line between sort of capital discipline and not getting over your skis on moonshots, but also sort of, stabilizing long-term growth opportunities? I mean, how many Disneys can there be where a company shuts down or lays off within their metaverse division before we start to question whether this is going to work at all?
Well, I feel a couple of years ago, we were on the other side of this argument, right, where the company was growing very fast, was spending a ton of money, and there were some issues around that, but the stock kept working. And all of a sudden, obviously, when top-line growth stalls, then, you're supposed to dramatically cut your costs even ahead of the stalling. They didn't do that. In fact, really very few names in our universe did that. And so as a result, I think going forward, you can count on one thing. One, with all these cost savings, the focus is on the bottom line. We think they're going to do at least $10 per share this year, which goes back to what Mark is saying in terms of how cheap it is on a PE base. Two, I think they are still aggressively investing, but instead of having the metaverse as number one priority, AI is now the number one priority, because that's obviously what everybody wants them to be spending money on. But they continue to spend on the metaverse. In fact, they're even leveraging AI to double down on the metaverse. But I would agree with Mark. I think the metaverse is probably a $1 billion spend as opposed to 10 or 20 billion. But I think the cost discipline is here to stay, and that's why I think this is a great story.